Hi, everybody. Welcome to today's webinar. We're going to be talking about investing in real estate through your 401k. So today we have Brendan Walsh from Rocket Dollar and Mike Jew from Doorvest. So why don't Mike, you start with a quick introduction.
Sure. Hi, everybody. I'm Mike Jew. I'm the VP of Demand here at Doorvest. So on the team that makes sure as you're looking for the home, understanding what's going on, have a nice, smooth transaction, you have a great experience finding the investment what you're looking for. A little bit about me, relevant to this conversation. I'm a super fan of all topics, personal finance and the market. And I'm a historical 401k maximum contributor whenever possible. So a fun webinar and a talk today that I'm really excited to get into.
Hi, I'm Brendan Walsh. So I work at Rocket Dollar as our partnerships lead. I've been at Rocket Dollar since 2018. The company was kind of just getting started there. And our goal, at Rocket Dollar was to build a financial platform for alternative assets and retirement accounts. Traditionally, these assets have been really hard to access in retirement accounts, just like real estate, private companies, pre-IPO stock, crypto, precious metals, etc. And our CEO, Henry, and myself both came from a financial advisor background. So I was a financial advisor in Chicago and, helping people manage their assets and their retirement in the stock market. And that was going all right, but it's really tough in financial advising. There's been a lot of fee compression and a lot of change in that industry. And I hope to really catch a rising wind here. There has been a ton of growth in alternative investments really coming into this space. So here at Rocket Dollar, we're really excited to partner with Doorvest and allow people to invest into individual real estate properties through their IRA in a compliant way. So I'm really excited to explain some of that and just some general retirement topics that we got going on in 2023. Last thing, it is tax time next week. So if you're in the chat and you're done with your taxes, maybe you can chat and tell us to celebrate. If not, I'm usually that last minute person trying to find some nights this week so you're not hating yourself this weekend trying to get it all done at the last minute like a final exam. All right, Mike, I'm really excited here today to get started. All right, so here are just some general retirement themes for 2023. I'm not going to say it's a super scientific or huge survey, but just some general trends and also we'll talk about some more like super current trends right now. So these first two are kind of some more long-term trends that I've noticed from when I first started being a financial advisor until now. The average American, I think, is becoming a lot more educated just on basic finance, personal finance, like Mike is saying, he loves to nerd out to this stuff and get interested in it. They're also getting the average American is getting much better at checking their financial fees and also advocating for themselves. Making sure you're working with a good institution, making sure you're checking with a representative. Do they have your best interest in mind? Some people have learned what a fiduciary means, where I would say 5 to 10 years ago, most people had no idea what that meant with their financial professionals. ETFs have become a lot more popular in the stock market. But when we look to retirement accounts as a whole, still a lot of money in mutual funds. And, an ETF, just usually a passive, not managed basket of stocks that kind of passively tracks, really popular with Vanguard investors. Mutual funds, still some mutual funds are low fee, but some are more high fee because they're active management. So ETFs continue to creep up in retirement accounts, but if you look as a whole, totally dominated by mutual funds. Bonds, not as safe as they were when I first started being a financial advisor. Older retirees could traditionally really rely on bonds because interest rates were relatively stable. They might not have been the most exciting yields out there, but it was very hard for them to drop. As interest rates have risen, we've seen some movement in bonds. It's hard for them to have a big drop, but people are considering other options sometimes to replace bonds in their portfolio, unless they are ultra conservative. And just an update for young retirees compared to older retirees. Younger retirees don't have too much to worry about. People that are in, below 45, you frankly got a lot of time. Don't be panicking right now. if you're below 40, you really don't have to worry about these drops. You should actually be saving if you can. We've had a lot of investors call us. You can see this is one where I did do a bit of research, before this webinar. There's a lot of older investors now that are really feeling pressure. Maybe they retired in the last 5 years, or they're about to retire in the next 2 to 3. They're really worrying about what's their current balance, trying to not mess with that overall balance or make a big mistake. And then Congress passed the Secure 2.0. This is a retirement relevant law. We'll go over the main points of it really quickly. It's frankly not anything earth-shattering, but there are just some new updates, mostly about higher contribution levels for some of the most popular retirement accounts.
So when we think about retirement planning, I think it can be challenging sometimes if you're just planning with no end in sight. Just I'm literally going to save and look for the highest yield I can. I think the more tactical way to think about this is just planning for future events, right? Whether it's college tuition, your retirement, large primary home purchase down the road. Specifically for what we're talking about today, more straightforward as you think about as you move towards the end of your career. Maybe it's many, many years from now, but nice to plan and know that that's the target that you're trying to hit. And real estate plays a great part in this. And what's been really fun for me, at least, is it's been progressing and evolving a lot over the last 20, 30, 40 years, where this used to be much more of an alternative investment, a little bit hard to actually do this. How could you even invest in real estate for your retirement? And moving much more to a core position. So in fact, for many of you that have 401ks or invested in funds, you'll likely have some REIT exposure or real estate investment trusts, where you are nominally invested into the real estate market. I'm sure there's many of you out there who are accidental landlords, just given the interest rate environment over the last couple of years. And there might be a couple of you who have already bought your first, second, third, or so forth investment property. I think what really makes this interesting in the context of a retirement account is, you have really creative ways to generate not just future streams of income, but to do it on top of an asset that appreciates over time. And the extra bonus magic you get to do here that was harder to access in the past, you actually could take leverage on this in the form of a mortgage. You can essentially magnify your returns on this amazing asset. So just as a quick shot for Doorvest, you wonder why I'm on this call. That's where Doorvest can be very helpful, right? We go and identify distressed properties in very nice neighborhoods. We do all the heavy lifting, buy the property, renovate it, get a tenant in place, get it into the hands of you, the investor, and property manage that property for the long run. The nut of it here is you should work hard at your own job. You should contribute to your 401k. You should save your money, and you should fund investments that will be passive, and it'll put you in a good position down the road. And we can help with that.
Great. Thanks for that, Mike. And I think a big theme of this slide, when I've talked with people that have dealt with retirement stuff, a lot of people feel behind or like they haven't given it enough attention, and they get really anxious about, addressing some of these bigger decisions that they have to make. And I would just say, look, it's okay to take some time to make some of these bigger decisions that, might be 5 years away, might be 10 years away, 15. As long as I see people make them within a couple of years, they're okay. You have a lot of time for some of these big goals. So don't be afraid if you feel behind. Just try to make some concrete steps today on these bigger decisions, even if it's not fully conceptualizing it. If you're making some little bit of progress, you're going to set yourself up for success. The only people I saw that did not have success with these big decisions are people that just put them all off. And then, they hit 55, 60, or 70, and they had made almost none of these decisions. Okay, we can go to the Secure 2.0 law. Okay, so this is a brand new law. It was passed by Congress. I believe it was somewhere near the end of last year, right at the end of 2022. There's a lot of stuff on this slide, but these are what we thought would be the most applicable to you as the general retirement user. There's a whole bunch of stuff that really only impacts, like if you work in HR or you're a boss of a company, like Andrew, the CEO of Doorvest, he has to worry about his 401k, and there's some stuff in the law that applies to, CEOs and HR, but not investors. So an RMD, an RMD is for what's called a traditional IRA. So traditional IRAs, you start and you put money into them and you defer taxes. So in your 30s and 40s, you're paying no taxes. If you make $100,000 a year and you contribute $5,000 to a traditional IRA, it looks like the government that you only made 95. So a little bit reduction on your income that you can compound that investment over time. An RMD is called a required minimum distribution. So you've been getting nice tax savings, that traditional IRA. Now you have to take that out of the IRA when you get to your 70s. So a lot of people will delay this as long as possible because they have income elsewhere. The government says, hey, we've kind of waited long enough. We got to get taxes done on this. So there are some slight changes to when you have to start taking an RMD. It's because people are living longer. They actually allowed later RMDs. So you'll see in the new law section here, some people can, depending on when you were born, you'll be able to take them at 73 or 75. Most people is around 72 for now, a change from 70 and a half. So it used to be 70 and a half, a few people would have to take out. Now most people are moving to age 72. Do talk to your tax advisor if you are on that edge, because that can be important if you are an older individual. Catch-up contributions. If you are over 50, there's long been catch-up contributions, which means, like we talked about, if you haven't saved for retirement for quite a while, you can use the catch-up contributions to stuff more in there all at one time. So you're paying a bit less in taxes to really grow your retirement account, because the government would like, they want older people to have a large retirement account. They don't want to have a lot of seniors, having trouble with daily expenses. So those will keep increasing. If you're over 50, definitely keep checking the catch-up contribution limits each year. And that can help you throw in sometimes an extra $1,000 or really kind of power save each single year. So again, just higher contribution limits, also through your 401k. So if you have a 401k at work, you can hit that, do higher contributions. You can also hit your IRA in the same exact year. Emergency withdrawals from an IRA, usually pretty hard to do, pretty aggressive 10% penalty. You should almost never do this unless you're really desperate. Some people hit that point and they really need financially. It's a huge weight off their shoulders to take money out from their IRA and stabilize their current financial situation. If you need to do that, there now is $1,000 penalty free that you can repay to your IRA within 3 years. That can get a little complicated, but as long as you do that carefully, you can avoid a penalty or getting hit on 10%, plus any current taxes that might have been waiting if you're in a traditional IRA. So that 10% plus current tax rates, that can sometimes add up to, well over a 30% tax rate. You don't want to get hit by that penalty if you don't have to. A big solo 401k thing. We're going to go over a solo 401k later in the webinar, but the main thing you need to know about that is if you're self-employed, really pay attention to that part of the webinar. There was a slight change for sole proprietorships to make it much easier to open a solo 401k. There's really a deadline at December 31st for most solo 401k new openers. You got to get it open by December 31st. Most retirement tax stuff happens on April 15th or April 18th or whatever our tax day tends to be. This change, well, if you're a sole proprietor, will allow you to open kind of a last minute solo 401k and really put a big contribution into there. Always check with Rocket Dollar and also your tax advisor on contributing to solo 401k, because it's very particular how much you can contribute depending on when you start it. Prohibited transactions. So, when you buy real estate in an IRA, you have to be very careful what you do with it. You cannot go stay, if you buy a vacation home or a rental home with Doorvest, you can't go like sleep in that home. Doorvest will help you. They'll be a tenant in it, so they wouldn't want you there either. But a common prohibited transaction is when people buy real estate is they go work on it themselves. They go remodel a bathroom. They go put new tile in the kitchen, and they committed a violation because you can't work on your property. So a lot of people get intimidated by these rules when they're first investing in alternatives, or they're investing in certain alternative assets. There is a big clarification in this law that says if you commit a really bad violation, it only terminates the IRA and distributes that IRA. So if you had 3 Roth IRAs and you made a huge mistake in one and that tax hit you, it would only affect the one Roth IRA. So this has helped a lot of investors that, they do a lot of run-of-the-mill, totally safe deals. They have a really exciting real estate deal that, or a deal that, they've talked to a lawyer about it, and the lawyer just says, look, it's a gray area. You could do it, or maybe I advise against it. If their lawyer says, hey, maybe this one's okay for you to do, but it's a little risky, you could put that in a separate IRA and shield that from all other risk of a prohibited transaction. So if you're ever uncomfortable, you can open a second IRA at Rocket Dollar and basically self-contain that riskiest investment in there. Okay, you can go to the next slide. Changing interest rates. All right, Mike, I was just talking for a while. So before I jump into this, do you want to tackle this from the real estate side of things? And then we can jump into some of these more stock market kind of topics.
Yeah, no, absolutely. Interesting times that we're in, perhaps an understatement, especially on the heels of what interest rates looked like over the last decade or so and what inflation looked like over the last decade or so. So an interesting spot where I think when interest rates from the Fed were just ratcheting up super rapidly, really hard to figure out and find your feet and figure out what you should do. But coming to a nice point here where all that seems to be stabilizing out a little bit, but still in the face of a high interest rate environment. So I think some of the notes here are really relevant and sort of good lessons as you would, if you would have come into the market in 2022 and 2023, right? Bonds a little bit more challenging in an environment where interest rates are whipsawing over the place, and for sure flashy stocks and trying to get into the market at the right time, which is always a trap, but a trap that possibly would have stung you extra hard if you were trying to figure that out over the last 2 years. The last note is super interesting, especially if you believe that we're in an environment where inflation will continue at this rate going on. If you want to play the traditional old school hide your cash in the mattress plan to plan for retirement, it actually hurts you worse than in historical times here, because that cash is getting to be worth a little bit less and less with every single day. Now, do you want to buy a big pile of gold and put it on your mattress? Perhaps, but the gold will just stay as gold. And that's the challenge investors are finding now, looking for assets that will move alongside inflation and the rates while still giving some appreciation. So sort of my quick thoughts.
Yeah, we have a lot of investors that, they're trying to be really defensive right now, but they do not want to miss out on market jumps wherever they may be if things do come back. And that's been a really not only frustrating, but challenging part of this market is as soon as anyone detects any type of weakening of inflation or weakening in the Fed's stance, the Federal Reserve saying, hey, we're not going to raise rates as much as we thought, all of a sudden this market has skyrocketed back. And, it's brought right back down to earth, maybe just 4, 6, 8 weeks later. We had a good first quarter here, but everyone is just like chomping at the bit for that last moment. But once we stabilize, we are not suddenly going back, to this high flying, super cheap money time. A lot of people feel that these interest rates are relatively here to stay or might stay elevated for a while. So this is changing what people are targeting. Again, like less the flashy stuff, more consistent income producing type investments that can prove that they're meeting their checks. They're not going to fail. No one's going to not stop paying. So yeah, we've seen a dramatic shift at Rocket Dollar for a lot of these high flying assets have gone away. And then you'll see in the stock market as well, you'll see a lot of boring company names that have been doing quite well over the last year and getting a lot more attention. And yes, the tech stocks, some of those have come back, but they have gone through them extremely sharp, painful drops that if you are market timing it, you've probably lost money. I know I lost a little bit. I basically gave up timing anything in the market. It was quite easy to time the market in 2019, 20, and 21. You just waited a little bit and it would go up again. No longer the case.
Yeah, and I think that's pretty interesting, right? We're all smart people. We think perhaps we can time the market. I don't think I've ever made a transaction where it seemed to work, except for in a bull market where everyone felt like a genius. Yeah, like to leave that for the pros and just look for the long horizon, slow and steady.
Yeah. And okay. And next we kind of really wanted to, I wanted to share these charts. This is from, this big chart is from Vanguard, and then I'm going to have one stat from the Wall Street Journal, just because some people always wonder, like, where am I at compared to everyone else? And if they can learn where everyone else is, sometimes that helps with a lot of anxiety, decrease their anxiety. Or two, maybe you are a bit behind and you want to save more. Hopefully Rocket Dollar can help you get there. So this is a Vanguard chart showing the average account balance of an average user. And I think, 34 to 44, about $100,000, about $180,000. You can read this chart here, but I think I wanted you to focus most on the 55 to 65. So when, Vanguard account holders typically are having $250,000 in their account. And then I checked the Wall Street Journal. If you're a household, probably combining two people's incomes and two people's retirement accounts, it's just a little or over $400,000. So, if you're on this call, you may or may not know where you're at. If you haven't checked your accounts, don't worry. Sometimes it's good not to check them. Some people have taken a pretty heavy hit, and it's not good to log in every single day and just have relentless anxiety over that amount. It's something you need to keep saving for. Making sure that you're not ignoring it, or it's not being ignored so much that the investments are in trouble. A common problem would be like not updating your investments at all in a couple of years, not having auto reinvest, so that bunch of cash is just sitting and not really getting back into the market. There's a lot of high interest things to put cash in now too, as you can get ready for a deal with Doorvest. If you're talking with them and if you're about to get ready to work with Doorvest, you could put something in treasury bills for a couple months. And then when you're finalizing your conversation with Doorvest, sell that quickly to have cash ready available for a deal. So, logging in once a month, a couple times a quarter is good. Logging in each day, agonizing about your balance, not that great. And these amounts are really helped by compounding interest. If you're a younger individual and these numbers look intimidating, how much can you contribute to an IRA this year? How much is your 401k matching this year? Can you just try and hit that? If that's a small goal you can hit, the compounding interest and performance over many years, even as things look dark right now, will be your friend. I've had younger friends ask me, should I not be investing at all? I say, no, you should be saving into the market right now. This is some of the lowest asset prices you might see in the next couple of years. So I've had younger friends, I'm 31. I've had a couple other younger friends start their first Roth IRA, put their first $6,000 in there and really get that going. Okay. For most Rocket Dollar customers, what's their primary concern when they're talking about their retirement? They're calling me or Nick or Tristan and our sales team. They might talk to us about a real estate deal or some startup deal, something that they're thinking about investing in. But often these are kind of the anxieties, they share with us, or they're excited that they just kind of hit a goal and they're starting a Rocket Dollar account to, finish that goal with us. Most people 27 to 40, you're just trying to save enough and start compounding. Typically, people in their late 20s, 30s, 40s, like unless your job is incredible and you're saving the whole 401k, sometimes your retirement balance isn't amazing. You just got to get started. You got to get started. You got to hit your 401k match if you have one. That's some of the easiest amount of money you can get. And you got to make sure it's invested. Don't have it sitting in cash for 5 years. There are people that make that mistake because they don't log into an old 401k. They moved it to cash like when the pandemic happens, and then they log in 3 or 4 years later. Oh my God, I haven't thought about this company in a couple of years. Oh my God, I left that in cash for 3.5 years. 40 to 55, this is where most Rocket Dollar customers are. We have customers of all ages, but most people are in their very late 30s to 55. They're really trying to grow their portfolio. They have some nest egg. They're still taking pretty aggressive risks at this time. They might change their risk up and down depending on how the markets are doing. Some have definitely changed their risk level the last couple months and years. They're also looking for tax efficiency. Generally, you're making a lot more at this time. people who never knew what a traditional IRA or Roth IRA start learning what a IRA is at this time, and they start learning how to use their 401k much more efficiently. And at 56 to 70, generally there's a very defensive mentality. Even the investors at this age that take risks will adjust and pull back their risk very quickly to go back to a more conservative portfolio if they see a threat. And we've seen a lot of older investors in the bull market. They were going higher risk. They were really trying to take advantage of this bull market, and they were frustrated they were not in it. So we have seen, I talked to my old financial advisor office. This happened a bunch. An investor in their 60s goes to the more aggressive portfolio, and against the recommendations of the advisor that's telling, we don't think you should do this, and they really push hard. They force the advisors to change portfolio. And then, we see some massive drops, and they got the anxiety is back again. They're now missing out, that they're no longer missing out on gains. They're feel like they're missing out, and their retirement might be pushed back a year or two. So, depending, often with real estate, a lot of investors try and think, around these similar mentalities or risk levels. So
following on what Brendan said, right? When you think about investing in real estate for your retirement, a couple of different stages that sort of begin from putting the money together so you can get the exposure to real estate through doing your first deals, and then as you get further along in your career and in your life, thinking how to manage your exposure to have the right amount of risk what you're looking for. I think the biggest secret sauce that people don't really think about a lot when they're thinking about, could I use some of my retirement accounts to buy real estate, is, unlike a regular deal you might do from your own non-tax advantage accounts, this money that you saved isn't money you can use for day-to-day spending. You couldn't go and pay rent with this money. They're tax advantage dollars, so they go a lot further than money in your regular bank account. And you can keep contributing to this over time. So you can really accumulate quite a few of these tax advantage dollars over time. And what does this mean when it translates over to real estate? I'm a little bit older than you, Brendan, so my strategies are perhaps one bucket shifted to yours, but I think it's a really interesting prospect as you get towards mid-career. You spent a bunch of your career, for those of you who are early in your career, start saving now. You've put together a reasonable retirement account. You're going to keep adding to it as you work, and you think, how can I diversify this so I don't just have pure exposure to equities? Well, the benefit here is, since it's not money that you would use in your day-to-day expenses, you don't have to worry about, well, am I going to make my mortgage or my rent this month, or am I going to fund this real estate investment? You can actually contain the entire bucket of cash all at once. Our client partners at Doorvest can help you here as well, and think about, okay, let's be smart about this. How can I plan to set this and forget this and just look at it when it's time to harvest, and put together the down payment that gives me the financial aspects of the deal that I want. We put aside into the account some reserves, so if there's anything unexpected, I have cash there that's ready. And then real estate, the same as investment accounts, right? Sometimes a lack of liquidity is the future. I'm sure you've all heard some of these old adages, but if you hold real estate for more than 5 years, everyone's pretty happy, and everyone can think of stories about people who bought real estate in traditionally challenging markets, held on to it for a long time, and it becomes the single best yielding investment that they have. Well, you have a pretty remarkable opportunity to do this in a tax advantaged way inside, say, a self-directed IRA. Set it, forget it, walk away. And when it's time, you can come and harvest those gains. And the benefit, you can get some leverage with the mortgage on this as well, which is quite unusual.
And we'll sometimes have investors go like, well, I don't want my money locked up for a couple of years. And we just tell them, like, look, your money is already locked up in an IRA. If you take it out, you got an aggressive tax penalty. It's frankly going to make it one of the, unless you're in a desperate financial situation, it's going to make it one of the worst financial decisions you make in your kind of financial planning life. So, the money's already locked up in these retirement accounts. You really should mostly think of it for a super long-term type of investment. So, don't be too worried about things that do lock up your money for a certain amount of time, as long as the risk is right for that lockup. That's the trade-off that you have to take whenever lockup of investment, you need to have, hopefully good risk that you're taking and appreciation that you can grab for that. And, people, I'd love, they have a couple real estate properties and they say, oh, I love pocketing that rent check every month. And then they go spend that on their family right that month, or, they go buy themselves something nice from it. And they can't mentally get over the fact that, oh, it's in a retirement account, so that rent check comes in and I can't pocket that. Really, you have to think, like, if this was in stocks, you would not be pocketing this either. If there was a good dividend, let's say you had a bunch of Exxon and a couple other dividend stocks, they gave you a dividend of $600 a month or $1,000 a month, you wouldn't be pocketing that either. So don't be intimidated that you can't pocket the money in a retirement account. It's for your benefit in the long haul.
There's an extra little real estate secret bonus here as well, right? If you think about, not unlike stocks or different properties, that some will just yield a lot of cash, give you a really great rent check you can pocket and, go on a nice vacation. And then on the other side, you could think about sort of big, highly appreciating markets where you see home values go up and up and up seemingly forever. And so when you try to pencil a deal there, sometimes it can be a little bit more challenging to find, a ton of cash flow that would spin off. Beautiful benefit here is you're looking at a 10, 20, 30, 40, depending where you are in your career, your investment horizon. You can actually cheat and get much bigger returns on appreciation over time than you would if you just got cash. So
great. Yeah. Okay. And let's go into what is a self-directed IRA. How are you actually doing this in an account? Okay. So what is a self-directed IRA? The first thing people think is they go, hey, it's something where I pick my own stocks. And that's true. That's also like just what people call where you trade your own stocks in an IRA. But as the way our industry uses it, sorry, I didn't pick the terms. The way our industry uses it is as an IRA that can invest in alternative investments. It is the same exact legal structure as an IRA that can invest in stocks and bonds. The IRS actually allows investors to invest in all types of alternative assets. They never really restricted you from anything other than a few exceptions. And like insurance or closely held business that like you can't invest in your own business, or like baseball cards, something like that. So it's the same legal structure, has pretty much all the same rules. So some people invest in real estate. They'll invest in pre-IPO stock. So SpaceX, before it IPOs, that really, that's not happening as much now, but the hot startup company that's getting Stripe was their payment processor. Everyone wants to get Stripe before it goes public. Private placements kind of means the same thing, but it just can be some private company or private investment that is not in the New York Stock Exchange, the NASDAQ, are out there. Private equity, a company getting acquired. Some people will buy a company, try and spin it up, buy a family business and try and spin it up to a much more professional operation. Crypto, very high risk, but still has its believers. And, it's not a one-to-one equivalent with gold, but we're seeing some investors kind of replace the precious metals aspect. We see a lot of younger investors saying, I don't want metals, I want crypto. That's my alternative asset. And then they'll put real estate and stocks together with the cryptocurrency. There's many, many more investments that you could bring into a self-directed IRA. So I just want to say this, if you start a self-directed IRA with Rocket Dollar and Doorvest, and you get a Doorvest property, that's great. Maybe that Doorvest property has income that's coming in. You can take that money, you'll need a reserve for repairs and stuff like that, and put this into these other assets. So typically our customers start with one deal. They come to Rocket Dollar, they want to do one thing. Slowly over the years, they'll pick up some other medium, smaller investments, and they tend to try and match the risk level of their overall stocks and bonds portfolio. They're not going into this account. They're not putting 100% of it on crypto and just blowing up their retirement account. They're putting a small percentage into crypto. They're putting a big percentage into real estate, depending on the risk level that they're going for. And they're going for some more conservative investments as well. So these IRAs, they can also be traditional IRAs that are not taxed in the current year and taxed later. They can also be Roth IRAs, where you don't really get a good tax, you don't get any tax write-off in the current year of 2023. So, if you're in TurboTax and you say, I put 6,000 in a traditional, you'll see the number go down that you have to pay in taxes in the little TurboTax in the top left corner. And if you just put that, I put that 6,000 in a Roth instead, you won't see any drop. However, as long as real estate is in a Roth IRA, it will come out tax-free if it's been in there for 5 years. So there's a bunch of tax advisor stuff, but if you have a huge capital gain after selling a property, if you make $100,000 in a capital gain, keep that gain in that Roth IRA for 5 years. You can withdraw that completely tax-free in your retirement. So older investors love Roth IRAs, and they also love big Roth IRAs. And it's hard to get a Roth to be really big. So some people will turn to real estate, they'll do a first real estate deal, and they'll try and go their Roth. Okay, we can keep moving. All right, so a lot of people ask, like, are there different rules for self-directed IRAs? And I would say, no, there are not different rules, but there's kind of stealthy rules that you've never had to deal with on the stocks and bond side. When you apply for a stock account, you'll see a little box that checks, does you or your family own 10% of a certain company, like Walmart, or a big publicly traded company, and you have to check that box. If you own Facebook, if you're related to Mark Zuckerberg, you would have to check that box, and then you would be under further scrutiny. So these are a couple rules that come up with real estate all the time. One of them is called self-dealing, and that means you can't mix your personal investments and your retirement investments. So a real common question, someone says, oh, Mike, I just heard about this self-directed IRA thing. My parents' property is incredible. It's going to make a lot of money. They're going to give it to me, so I'm going to put it in my IRA. Nope, cannot put that in your IRA, not allowed. Can't put your own property in an IRA. Cannot put your vacation property in an IRA. Let's say you have a great investment property. It's been income producing. It's been amazing for like 6-7 years already. You cannot put that in your own IRA. You could sell it to someone else that has an IRA that's not closely related to you, but you cannot put it in your own because you'd be hiding the tax benefit from that. Another common thing of self-dealing, you can't work on your properties. You can be more of like a paper pusher, doing admin work, helping with, is it electronic signature or physical signatures? You can look at the property and you can walk through it, but you better not be cleaning the property, putting additions on the property, handiwork, the toilet breaks. Always call a contractor or have a handyman that's kind of on your speed dial if something goes wrong with with a property in IRA. And again, Doorvest is a awesome method to protect from that. So Mike, can you just quickly comment on like when those maintenance issues come up, how does Doorvest handle that for real estate properties?
No, that's a perfect question. And the short answer is, you guys remember the beginning of the Doorvest journey where we're buying, distressed homes in nice neighborhoods, fixing them up. We also manage the properties as property managers in the long run. So short story is, a toilet gets clogged and someone needs to do something. You don't have to run out there. Well, in this case, you can't even run out there and do something about it. No problem. Our property management team is in touch with the tenant and they can deploy someone to take care of it. So it saves you time, but also in this case, keeps you safe in terms of the IRA rules.
Yeah. And we have investors at Rocket Dollar that have all different types of real estate. I would say owning real estate and not having a property manager, that is the advanced. Being on a skateboard, jumping over a big jump, like that's not for most investors. Most investors should have as much distance as possible between any of this physical work. They shouldn't be anywhere near it. Doorvest allows you a whole level and layer in between handiwork that you really can't do as an IRA investor anyway. And some people get into trouble. They're going on, they're hiring all these people and they're managing it from their IRA, and then they make a mistake. And that can put into doubt the entire IRA and this, great tax savings that they've gotten on this property investment. So simply, Doorvest is already, that's why we thought this partnership was great from the get-go. Doorvest is handling one of the most major risks when people they're kind of hesitant to come into Rocket Dollar. They say, hey, I see some real estate risk. I know someone that screwed this up. Doorvest is already protecting from that, one of those self-dealing problems. Sorry, there's one more rule I got to go through real quick. Sorry. Prohibited people. You can't invest with your spouse or your parents or your kids. It's usually outright prohibited. There are some advanced strategies. You can invest with your spouse, but they're generally extremely complex, and you got to be really careful how you set it up. If you want to talk about that, we can talk to at Rocket Dollar, but if you and your spouse are really excited about Doorvest and your IRA, the easiest thing would be the husband buys a property individually, the wife buys a different property. The IRAs stay totally 100% separate. If you do need to somehow combine forces, we can talk to you, but it generally takes a lawyer, some counseling and setup, and it's very complicated. I wouldn't ever recommend it for your first deal in real estate. All right, we can move on. Okay, so I said these IRAs are very similar. This is one part of our industry. It's the same legal structure of an IRA, but it has some extra things attached to it that give some benefits to real estate. So a lot of people, when they, again, I don't choose the terms in this industry, so this is an older term, but it's how people refer to it. They call it checkbook control or an IRA LLC. And the reason why they call it that is it's an IRA that owns kind of like a king LLC that owns everything below it. That LLC has a bank account, and you can kind of see that in the purple diagram at the bottom of the screen here. So people say, oh, I want an IRA with checkbook control. And what does that actually mean? It means that as the manager of the LLC and of your IRA investments, you can actually cut a physical check and write it to someone for a deal closing, for a down payment, for a contractor that needs to be paid for, let's say they did a big remodel, and maybe Doorvest is handling that for you, and Doorvest is billing that for you. You can also use wires. You can sometimes use ACH, depending on where you're sending it from. So long story short is you have control of where that bank account money goes. If you're only just sending it to and from Doorvest, that's also keeping you protected. This is not money that you can pocket. You can't buy a coffee with it. This is your kind of IRA's money market account. All of your dollars and cash for your IRA sit in this bank account until they go out and invest in a real estate property. Investors will also kind of keep their cash reserve in here. So, if you buy a property for $300,000, Mike, sometimes there's, Doorvest tries to protect against this, but sometimes there can be an unexpected repair. Houses just break, things happen. I'm a new homeowner. Things just happen in a house that you're not prepared for. So it's always good to have a reserve, especially in an IRA, because it's harder to get money into an IRA. You got to make sure you can contribute it with the IRS, and then you have to actually get that money in there, at Rocket Dollar and get that into the bank account. Two other really big things in here is some IRA custodians, they will ask to approve every single real estate investment you do. They will also ask to approve every single transaction or bill pay that you do. And there are ways to make this easy, but easier, I would say. But with real estate, there's just a lot of transactions that come up. So if you need to ask your IRA custodian every time a toilet clogs, every time a repair comes up, hey, we need to pay the plumber $700. Hey, the electrician came 2 weeks ago and he still needs payment. Hey, no one responded to the electrician. It's 3 weeks now and he still hasn't got paid. He's getting upset. He's not going to finish the job. The bank account here allows for instant deal approval. So if you see a property at Doorvest that you're good to go into, you do not have to ask the IRA custodian for permission. We have a structure at Rocket Dollar called direct custody, where the custodian has to approve every single investment that goes through. It can work for a passive real estate fund. It can work for an individual property, but it's very difficult. With Doorvest, the Doorvest is just accepting the IRA LLC account because that allows a lot of flexibility to pay your expenses quickly, keep everyone happy, and make sure, again, the rent money coming back to you is paid on time to you. your rent checks will be deposited back to this bank account. That's another benefit, is sometimes an IRA custodian can simply take a long time to process your 12 rent checks coming in each year. All right, we can keep moving on. I know we got a few more slides. Mike, do you want to handle this one? I think, and I can add in some color where needed.
Sure, absolutely. If this is the kind of thing that you want to get started, I think there's some nice information to begin here, but you're probably going to want to dig in, get a sense of what you might have that's investable in a retirement account and what that might translate into in terms of a real property, and think about what the exit might look like, or perhaps what a longer term real estate strategy might be. So if that's the case, love for you to come and sign up at Doorvest. That's just the first step. What that'll do is allow you to get look at properties and get on the phone with one of our client partners. Please mention, if you're thinking about this strategy, that you're thinking about leveraging a self-directed IRA and working through Rocket Dollars, so we can make sure that A, they can tee you up for the right strategies, but B, also so that we can work closely with Brandon's team over at Rocket Dollar to make sure everything goes nice and smoothly and moves quickly. I know Brandon's got some details and perks here for you all as well.
Yeah. So we usually our fastest account, our most expensive one, that's our gold account. That is done in 2 weeks to set up an account, and that's from start to finish. So we have a pretty great discount code here that's more suited for our silver account. Our silver account is $360 and $15 a month to get started. That is usually done in 3 weeks. That Doorvest VIP code will knock off that entire $360 opening fee. It'll just be $15 a month to open and maintain your account. So that's going till July 1st. You don't have to invest with Doorvest on like the first day that you open it. You have some time, but that's going to be a really awesome code. It's probably the best one we could ever give. And that will expire on July 1st. We'll obviously have some great perks with Doorvest still, but it is not going to be that good once that one expires. We also want to check with you, do you have a traditional or Roth IRA? Do you have an old 401k where you left your job? A common thing people think is, oh, I have all this money in an old 401k, I still work there. Well, if you work there, you cannot pull that money out. It has to be old 401ks or old IRAs. So we can work with that with you. And our main goal is to make sure you have the funds that you expect to be able to purchase the property at Doorvest that you really like. We can help you consolidate those accounts. We can help you make sure they're all in the right spot, and so that you don't have any difficulties come funding time or jumping on an awesome property. You can call our phone line, and then there's our email there. And the Doorvest VIP code will be entered at checkout. Always let us know or email us if you had some trouble or maybe it didn't get entered. Number 3, will you finance? You can do a financing through a self-directed IRA. It is not called a traditional mortgage. It is traditionally called a non-recourse loan. And the biggest lesson from that, I don't have enough time to talk about it in full detail, is just that you cannot co-sign on the loan. So there's some pluses and minuses to that. You'll have to deal with a specialized bank. We have a bank that you can go to. We also, there's another list of other lenders too that you can go to, but we send a lot to our main partner bank because they understand these types of accounts. And with a Doorvest type property that's ready to rent, they're very understanding of what's the risk there, what's the awesome benefit there. Will you be a good, loan paying client with that account? Step 4, we will do that as quickly as we can, but that's rolling over your old retirement accounts. Sometimes those can be slow to move over. We're getting the best technology we can to move from different places. Fidelity is pretty fast. Vanguard and Schwab and TD Ameritrade, they're okay. And then everyone after that can be really bad and really slow. So we always want to make sure we're talking to you early. We're getting that stuff done early, so you're not sweating. You love the property and you might lose it because you didn't figure out where your 401k was and you kind of forgot where it was. And then, Mike can talk about committing to the investment. They have a whole process for that and a closing that they walk clients through.
Yep, I think Brandon's hitting the right way to think about this, right? You line up your financing, make sure everything is in a good place, start talking to our client partners to make sure that you're able to plan ahead and know what you're looking for. Once it happens, relatively straightforward, and now you'll see why you're going to want to make sure you have money in place at the retirement account that you want to deploy from. Simply, you can talk to your client partner, or you can do this all online. You can reserve the property. There's a property reservation fee. Feature of the Doorvest platform is, unlike in a regular housing market, at Doorvest, once you select and reserve a home and you pay your reservation fee, it's yours. Nobody can come in and outbid you and try to wrest it out of your hands. We make sure that belongs to you and you only. Now, of course, you need to fund and purchase the property in a timeline before we might have to throw it back to the market. But if you have everything lined up with Brandon's team here, it'll be no problem at all. And we work closely with that lending partner as well to make sure that for these kinds of properties, they know what you're looking for and relatively straightforward for them to step through it in a quick and predictable manner.
Yeah, and you will have to pay that reservation fee from Doorvest from your IRA. So that's a good one, just motivation to get the funding started quickly. Get that started so you're not having anxiety, and you don't want to pay that personally, because that can cause IRA issues with your IRA and compliance later. I'm going to quickly go through the solo 401k. We have about 6-ish minutes left on the hour, but this is really important if you're self-employed. I think if you're self-employed and you have a small business and you have no employees, if you have a couple employees, there's potentially a SEP IRA that we could assist you with. But also, you just have to take this seriously because it's such a big benefit. Because a lot of self-employed people don't have as good of a 401k as a person is a big corporate job. So we have Dell's a corporation in Austin, Tesla's here now. Those people have great 401ks. Since it's such a big company, the 401k, the red carpet is laid out. This is how you lay out the red carpet for yourself as a self-employed individual, or if your spouse is self-employed. You can also use this if you have a side hustle. You can contribute to the match at your current W-2 job. And then if you have a pretty good side hustle that's producing income, you can use a solo 401k as well. You have to make sure you don't double dip too much. There's a ceiling you can run into if you use both of them too much, but you can often make a really good use of a solo 401k, even if you already contribute to your 401k. And we've seen a lot of people save a lot more. They'll contribute up to their match, they'll get all that great money, and then they'll save another $10,000, $15,000, $20,000 through their solo 401k. So it's an employer-sponsored retirement plan by your own business. So some people think, well, I don't have an HR department. You're wearing a couple of hats here. You're the employee. You're also the employer. You're kind of your own boss. So it has a lot higher contributions than a traditional IRA. Instead of $6,000, $6,500, that amount is going up in an IRA, but it's still so much less than the $20,000 you can put into a 401k. Then if you put a match or profit share, you can get even higher. Some people can get up to $55,000, $60,000 if they really maximize this account. You could also take out a loan. If it's up to $50,000 or 50% of your account balance. This money, we've talked about all these restrictions. You can use that for anything you want. So people, that frustration, I need to buy something nice for my kids. They're going to college. My daughter doesn't have a car, and I need to make sure she has a car to go to and from college at university. You can take out a loan, finance that from your old solo 401k, and then you pay back yourself. You will actually pay interest into your own 401k time. And there is also ways to do massive amounts of money into Roth. You can call Rocket Dollar to find out. All right, we can go to the next slide. This is a quick diagram of it. I would say go to our website if you want to learn more. It's a plan document. It is a retirement trust. So instead of an LLC, like the IRA LLC, this looks more like a trust. And you're in charge of this trust as the trustee. So you're like the head of HR or the CEO of this plan. You decide where this money is invested. And one thing to know is there's pre-tax, or what people think of as traditional, and there's also Roth in the same account. So instead of separate IRAs, you can put a huge nest egg and have two separate accounts nested in the same trust. All right, keep going. All right, and one last complicated thing to know is there is a tax that can hit you in financing called UBIT, or unrealized business income tax. This is something to be aware of, not afraid of. I would say this is the number one thing that intimidates people too much, and they miss out on a real estate deal that they should have jumped in on, but they didn't understand this topic. So we have advanced resources at Rocket Dollar. We also have CPAs that can help with this. And a great thing, again, if you're a solo 401k user, is that it impacts IRA users. The more that an IRA user finances, the more UBIT that they could get hit with. It does not impact solo 401ks. So solo 401k users don't have to worry about this. So we'll have longtime real estate people shift over their real estate activity to their solo 401k because it's completely away from this tax. And if you have an IRA, don't worry, a CPA can write that off with business expenses and really reduce that tax. So some people will finance less of a property and go more cash heavy. All right, I know we're right about at the hour here.
Yeah.
So Chris, we can close it out here, but I just wanted to get all that out on UBIT. And you can go to our Rocket Dollars website to learn more about UBIT. We can also introduce you to a CPA if you have questions about that and how that impacts your Doorvest investment.
I think this is a phenomenal talk. This is a topic that we could talk for many, many, many hours about, of course, but always excited to help investors take their first step in real estate investing, whether it's in, the regular portfolio or through their retirement account here. So I know that our team would love to talk to any of you, help you navigate through whatever we can, hand you over to Brandon for whatever parts his team can help navigate through, and get a wonderful rental property into your retirement account as you build towards that nest egg.
All right, and I know we're right at time. So Chris, what's a good email for Doorvest? And then we can put Rocket Dollar's email in the chat here.
Yeah, for sure. Head over to doorvest.com or rocketdollar.com to get started. You can contact Rocket Dollar at info@rocketdollar.com and then Doorvest at clientpartners@doorvest.com.
All right, great. Thanks so much, Chris. Thanks so much, Mike. A great webinar today.
Thank you, everybody.
Brendan.
Take care.